Talk about the very last part of how do you initially handle accounts receivables. And we talked about the difference between a gross method and a net method. So now we're going to talk about how we handle sales returns. Okay? And what first I need you to understand is that sales returns is considered an estimate, all right? And basically what happens is that what we do with sales returns is we estimate at the end of the year the amount of sales returns that we expect to receive the following year. And the reason we make that estimate is because we know the reality is that we're going to get some type of returns. And sometimes those returns are so substantial that they can really affect our financial reporting. They can really affect our income. And we don't want to have our income thrown off from major returns that we can anticipate. And so if we make the appropriate estimate at the end of the current year for any returns that may happen in the future, our financial statements will have more of a reasonable, accurate prediction of our income. And so that's all we're doing. We're estimating based on our previous experiences of what type of returns we're going to have so that our income could be fairly more accurate for our viewers. Okay? And so that's what an estimate does. And so what you need to understand is that you're going to have an estimate for returns, and then you have a follow-up journal entry that's going to show you how to actually handle the actual return. So your return, your sales return estimate. Now your sales return estimate is going to be directly after you've sold it on the account, right? It might not have to be on the account. It could be for cash, but normally it is on the account, right? You normally sell stuff on the account. And so you've already recorded the debit to accounts receivable, credit to sales revenue. You've already done that. But this is the end of the year, and now it's time for you to make that estimate on a portion of what you expect not to have sold officially, because someone is going to do what? Make the return. So this is your year-end estimate return. So what you have to do is you have to debit sales return, and you're going to credit allowance for sales return. For whatever number. You also have to put inventory back on the book, essentially. And so what you're going to do is reverse your sale of the inventory, and you're going to debit inventory, and you're going to credit cost of goods sold. So it's a dual-step process, right? And of course, this number, because we're dealing with inventory, will always be the cost. Not the selling price, but the cost. Okay, so this is your actual estimate that you're going to make. All right? Now, once this estimate is done in the current year, you proceed through the following year. And the reason this is important because now this have already adjusted your financial reporting. So let's talk about how it does that. Well, you've already put inventory back on the books, so your inventory won't be overstated. And you also reduced your cost of goods sold, which is an expense, so you're therefore adjusting your income. Now, sales return is actually a contra account to revenue. And it's actually doing what to revenue? Decreasing it, obviously, right? So we know that we're decreasing it because we're expecting it to be a return. And if somebody returns something, your revenue goes down. However, the allowance for sales return is a contra account to accounts receivable. So obviously this is doing what to your accounts receivable? It's decreasing your accounts receivable. Okay? And so this will happen in the current period at the end of the year. Now, what should take place the following year when a person actually gives a return? When a person actually gives a return after estimate. So we're going to say return after estimate. So the estimate was done. Now we're following up with the return. The return after the estimate would dictate you to remove everything related off the books to accounts receivable. So that would be accounts receivable itself, as well as that contra account to accounts receivable, allowance for sales return. So you would remove allowance for sales return off the books by debiting it. And you would also credit what? Accounts receivable. Okay? And so this is pretty much a two-step process for sales return. The estimate, you have to understand this journal entry. And once you have already estimated, when you have an actual return, this is your follow-up journal entry. Okay? So let's look at an example. This example says that the company allows the customers to return merchandise for any reason up to 90 days after the delivery. It says the company begins the year with allowance for sales returns of $300,000. So I'm going to erase all of this stuff because we're going to need this stuff. Do what we have to do. So we have a beginning balance of allowance for sales return. Allowance for sales return of how much was it? 300,000. It also says that the company sold merchandise on their account of 11.5. So credit sales. $11,500,000. And it says the merchandise cost Halifax. So the cost of it was $7,475. Cost of inventory. And they said that was 65%. 65% of the sales, right? Then they said that the customer returned $450,000. So that's an actual return of $450,000. And it says sales return estimated to be 4% of sales. So the estimate is equal to 4% of sales. 4% of sales. And they want us to prepare the entry to record the merchandise returns and the year-end adjustment of estimated returns. Okay? So let's pay attention to what's going on. We started out with a beginning balance of allowance for sales return. We know this is a contra account to what? Allowance for sales return, accounts receivable, right? So we say this company started out with this. Now there's something that you have to consider because this is a key to you understanding. If the company had a beginning balance this year of this, what is this really telling us? This is telling us that in order to have a beginning balance, last year it had an ending balance of that. The ending balance the previous year is going to equal the beginning balance of this year, right? So what are we really saying? We saying that this was based off of last year's estimate. So they already made an estimate saying that this year they was expected to have how many returns? $300,000 worth. So they already made the estimate last year, because that's why we have a beginning balance of this year. But then we had an actual return this year of $450. First thing they want us to do is to record the actual return. So let's record the actual return. Did we already do an estimate? Yes, we did. So this is an actual. How do we know? Because we have a beginning balance of 300 for allowance for sales return. So actual return after estimate. So how do you journalize that? You remove everything off the books of accounts receivable. So you go debit, allowance for sales return for the actual return amount, which was what? $450. And you're going to credit what? Accounts receivable. Look at your notes, what I the previous lecture. Which is what? $450. Then they want us to make this year's estimate. This year's estimate. And it's going to be based on 4%, right? Because they said 4% of sales. So how we make your estimate? Again, look at your journal entry, right? We're going to debit what? Sales return. And we're going to credit what? Allowance for sales return. Then we have to put inventory back on the books. So we're going to debit inventory. And we're going to credit cost of goods sold. So how are we going to calculate the amount estimated to be returned? We said the estimate was 4% of sales. How much sales we had this year? 11,500,000. So we take 11,500,000 and multiply that times 0.04. 4%, right? So we take 11,500,000 times 0.04. And that gives us 460. So 460 is going to be our journal entry for the first part. Keep in mind, as I said earlier, your inventory has to go on the books, but it goes on the books at cost. So technically, we're expecting to return our customers to return $460,000 of inventory, but how much did that cost us? Based on what we calculated earlier, it cost us 65%. So we're going to take the 460,000 times 0.65, and that should get us $299. So this is our current year's estimate, moving forward to the following year. Okay? So make sure that you rewrite this and watch this again, because this is a good example connecting the dots for a sales return.